Money Mondays.
Oh, wait, sorry, that's Price is Right, isn't it?
Well, that's close enough, dude.
Money
We need to have our own
Mondays-
theme song.
We do need a theme song. Shannon is going to get right on that one.
She is all over that. She's laughing at us.
Welcome back, everybody. Money Mondays, which is every Monday, 3:30 Central. We talk about a bunch of different topics. Spend about 20 minutes talking about said topic, and the last 10 minutes is open Q&A.
Yeah, and the Q&A is the most important part, folks. So if you have questions, comments, you want to give us, maybe a subject that we should talk about on a future show, please drop them in the comments, hit us up. We want it to be interactive, and that keeps down on the amount of talking that Ben has to do.
Absolutely, but welcome back to Monday. Hope people had a good weekend.
Yeah, we missed the last one or two, right?
Yeah, last one was a holiday, right?
It was a holiday.
What was
Gosh,
the holiday
man.
last? It was July 4th. July 4th.
Man, that feels like that was like a century ago. That was literally last week.
Yeah, well, it's because we had our raise. We had a big deal that we were working through that week. So I think that's probably why me and you felt it a little bit, because a lot went on. But we're done.
We're done with said raise, Excited about that deal here in Houston. You guys probably saw it if you follow us. Who are we partnering with? I just gotta at least plug that.
Brandon Turner and Brian Murray, Open Door Capital, so some good friends. And collectively between them and our other partners, we got the deal done. So $23 million raised, and Ben's having to call back about $2 million of investors and tell them sorry. We're a little bit over.
No, we're not doing that, my friend. But what are we talking about today?
We're talking about cap rates, and it's actually a good timing.
Oh my gosh,
cap rates. We were just talking to a broker about cap rates no less than 10 minutes ago.
And we were disgusted about how low they actually are.
Well, we'll only discuss it whenever we put our buyer hats on.
That's true.
We feel fantastic whenever we put our seller's hats on.
Yes.
Luckily, the first half of that call was about the sell side of things. Then we had to put our buyer's hats on.
So we'll get into what a cap rate is, but I want everybody to think through this, right? When you're a seller, you want your cap rates to be low. When you're a buyer, you want your cap rates to be high, and we're going to get into why that is. So take everything as we're talking about it, and have that in the back of your mind, right? So we're talking about cap rates and how does that play into analyzing multifamily properties. And really, I think you do a good job kind of describing what a cap rate is, right? Kind of breaking it down, as a way to value property.
Yeah, so I'll go ahead and kind of dig into it, right? So how do you, the question is, how do you value something, right? If I'm trying to value a phone, I'm probably looking at what the same phone sells to other people, right? Mm-hmm. If I'm trying to value a house, I'm going to look at what other similar houses in the neighborhood sell for. Now, if I want to value a piece of commercial real estate, I can go see if there's a similar property. The problem with commercial real estate, it's hard to find similar, right? There's not enough density, right? You don't have 1 million properties in 1 mile like you do, with houses, right? You have a whole neighborhood to look at, right? A whole 2 neighborhoods. Yep. Commercial real estate, it's more spread out. We all know real estate is very location specific. And on top of that, every property is a little different. This property is 2 square feet, 2 floors. This is a 1 floor. This has got, 2
bedrooms. This one has all 1 bedrooms.
On the commercial side. So they're very different. And so instead, cap rate is that continuity, right? A way to value a piece of commercial real estate. And it's really about valuing commercial real estate based on its revenue. That's in a nutshell what to think about. So cap rate helps you understand what is this piece of real estate valued, and I'm valuing it based on what money it actually generates, right? And so what's the equation for cap rate? It is NOI divided by valuation, right? So a cap rate, just the simplest way to think about a cap rate, what it actually means though, is let's say Ben has a farm, right? Ben looks like a farmer. He wears boots occasionally, right? Now Ben, on his farm, he is making, he has some equipment that he has, right? He pays the government taxes for the land. And, let's say he's got a bunch of farm equipment and he's got monthly bills to pay, right? Now, if I buy that farm from Ben, right, I'm going to buy it on a cap rate. And it's basically saying, okay, if Ben sells it to me at a 10 cap, right, if I do what Ben is doing, all I'm doing is switching Ferris for Ben. Ferris is going to make 10% return on that property, ignoring debt, ignoring everything else, right? Just I'm going to give Ben $1 million and I can expect to make $100,000 year one if all I did exactly the same thing as Ben. I wake up the same time as Ben, I go to bed at the same time as Ben, I use the same machinery as Ben. Nothing different, right? Now that's a 10 cap.
Now, one thing, just let's pause there because you brought up a very, very good point, right? Does not take into consideration your loan or what we call in commercial debt service.
It's just saying if I bought it all cash, that's what I mean.
Cash.
So all of that stuff is multipliers, it starts giving you leverage and some other benefits, right? But now, let's say Ferris knows how to add more value. Ben was farming tomatoes and I'm like, you know what, we should farm our oranges, right? Because I can drive more revenue, right? Now that property's making $200,000, right? Because I sold oranges instead of tomatoes. I've doubled the revenue, I've actually increased the cap rate, or actually, improved the collections, which increased the value, right? And now I can go sell it to the next guy. And again, if that guy just did exactly what I did, he's going to get that $200,000, right? So cap rate helps you compare different properties that aren't necessarily like for like, because you're basing it based on revenue, right? So now let's unwind all that, right? So it's NOI, right? Net operating income divided by value. So if my NOI goes up, my cap rate stays the same, my value is going up, right? If cap rates compress, right? We've been seeing a lot of cap rate compression. We bought deals in 7 cap markets 2 years ago that now are 5 cap markets or 4 cap markets.
So compress means getting smaller,
So if you guys
folks,
think about the equation, so if this piece of the equation changed, right? So cap rate equals NOI divided by value. So if the only thing that changed was the cap rate, right? The market got tighter, so now that 7 became a 5. Well, guess what? My value changed significantly. It actually went up, right? Because now you're dividing by a smaller number to solve for the value, right? So that's cap rates in a nutshell, right? There's other things that help you juice your deals, like we talked about leverage, some of the other stuff, but cap rate ignores all that. It's all your fixed cost, right? All the above the line costs, right? That kind of go into that.
And one thing to also take into consideration, folks, right? That farm that maybe, Ferris is going to buy from me, that's in Texas, right? That same farm might be the same thing, might even farm the exact same thing, but it's in California, right? My 10 cap deal, even though it's the same dang thing, is probably going to be like a 4 cap or 5 cap deal in California. Why is that though, right? Because it's driven by the market that it's in. And really people are like, well, how do you determine what the market cap rates are going to be? I would say the brokers are probably the best person to really call what market cap rates are. And so you just need to be talking to the local brokers that are doing a bunch of deals, right? They're going to say, yeah, C-class deal in Houston is going to be, 4.5 to 5 cap. Which is exactly what it is, right? A B-class deal is probably 4 to 4.5. A is probably somewhere in that 4 range. That's what it is. And that's because they're trading at that valuation right now, and they know. And so the broker themselves are going to be the ones that are really going to be able to tell you that, ultimately what the cap rate is. So wanted to point that out because you can have that exact same farm, but if they're in 2 different markets, and ultimately the cap rate that you're determining that value on is ultimately going to be a lot different, right? And so, we use this both on, does this make sense going in? Or what's our stabilized cap rate gonna be? That's probably the more important number for us, right? Because some of our deals are value add, they're not gonna be stabilized.
And this is where it's interesting, right? In some markets, a value add deal might be a lower cap.
It absolutely would be lower.
So let's use an example. Let's say you have a little rinky-dink apartment right in the heart of Manhattan.
Yep.
Right? Let's say that property owner produces $1,000 a year. Right. Someone may pay you a 1 cap for that deal.
Yep.
Even though Manhattan might be a 3 cap market. Why? Well, because they know if they demo it and build something else, they can get significantly more NOI.
Absolutely.
Right. And so cap rate is just kind of an indicator, but there's really other things to think about around, because as another actually really good example is debt. As debt has gotten cheaper, people are willing to pay tighter caps, right? Because they're looking at that spread. They're really playing arbitrage, right?
Yep.
Cap rate is kind of a way to play arbitrage on debt.
Yeah.
Right, and so a cap rate helps you just understand valuation.
Let's pause there, because this is a creative way. This is actually we look at this quite a bit, actually, right? If your interest rate is higher than the cap rate you're going into, you're probably not going to be making any money, right? Whereas on the inverse of that, right, if your cap rate's high and your debt is low, you play that spread, which is what he's talking about, arbitrage, right? And that is a thing. You can literally go and try to do the numbers right now.
Remember the value, because cap rate does not include debt service. So let's say you're buying it at a 5 cap and your interest rate is 3. Well, you're getting 2% of a spread on that deal plus the leverage. So you're actually, that's how you get from a 2% spread to an 8% return, right?
Yes. Because
now you're leveraging up an 80%. So if you take the 2% and divide it, by 0.2, I think the math, and that'll get you to that 8% that you try to get to, right?
Bottom line, spreadsheet this out, folks. It's actually a thing, and it's very important.
We all do big math in our head?
Not all of it. I like to use a spreadsheet.
Then what is 2 divided by 1?
2 divided by 1, 2.
Smart guy. That's why I partnered with this guy.
Oof. I wasn't quite sure if it was a half or what, But anyway, so you can use this, as a way to really, right off the bat, start figuring out, hey, is this going to make sense, right? So that's kind of how we use cap rates in several different ways. Once again, going in cap rate, what's a stabilized cap rate after, say, year 1, after we've done our value add, and then ultimately on the back end, What's our exit cap? So that's probably one of the most important things, right? And ultimately probably one of the most difficult to determine because nobody has a crystal ball. Where are cap rates going to be? The rule of thumb used to be every year that you held onto a property, you should add 10 to 15 basis points to your cap rate, right? So for example, if you bought it at a 5 cap, you're holding on to it for 5 years, and you're going to add 10 basis points each time, you're going to be selling it at a 5.5 cap. Right, and then you divide that by, the NOI is then divided by the cap rate, and that's going to determine what the value of the property is, and that's important in ultimately what your returns are going to be and what you're going to show to your investors. So the exit cap rate is a very difficult thing to determine, right? Typically we just err on the side of being conservative, even though this last couple of years cap rates have been going down. Right? We don't anticipate them to go down indefinitely. Ultimately you can only get to 0 and it's going to be hovering there. It's never going to be negative. But they could compress a little bit more. Who knows? It really determines on, I think, interest rates and inflation.
Absolutely, right? But then also the inflation is the other one, right? So even though even interest rates may go up, cap rates may stay the same. Why?
Possibly.
Because the revenue, so if you think about the math equation, guys, I wish I had a whiteboard I could draw on. But again, if cap rates went up, but my revenue also went up because of inflation, right? They cancel each other out.
And inflation, right, folks? Rents will be going up, is what he's talking about, right? And so that's something to kind of determine. So, what does a new multifamily investor need to know when it comes to cap rates, right? I think that's one of the first things you need to get familiar with. You need to talk to the broker that's in the market that you want to be in, where cap rates trading at. That will give you a rule of thumb as to where are you buying a good deal, a bad deal? Maybe it's a low cap, like Ferris said, but you've got a lot of upside. Throw that going in cap rate out the door and look at what your stabilized cap rate's going to be, right? So some of the biggest misconceptions, some of these questions kind of came in ahead of time in the industry when it comes to cap rates, that it's the end all be all. We do a lot of value add plays, and we'll have people constantly ask, what's the going in cap rate, right? We had that several times on this last raise, right? It's not a stabilized deal. Right? Now, it's a nice looking property. It's got a lot of great potential, but it's not humming 100% stabilization and where it should be. So it's trading at a lower cap rate than traditionally it would be in that market, right? So that's probably the biggest misconception, is that going in cap rate is like the end all be all of all metrics. And I say no. Really what you're looking at is your stabilized, cap rate, right? What is it going to look like after year 1, maybe even after year 2? Right? If you're able to take that 4.5 cap, and now it's a 6.5, 7 cap, that's pretty good on a stabilized cap rate. All right. So we talked about what cap rate compression is, right, folks? That's just cap rates are getting lower, and that's been happening the last couple years. We don't know if that trend's going to continue. Once again, it really determines on inflation as well as probably where interest rates are going to go, and nobody has a crystal ball. But cap rate expansion could potentially happen, where they're getting higher. I don't anticipate multifamily going back to being a 7, 8, 9 cap, asset class. It's just not going to happen. There's too much demand for it, because that also plays into cap rates, right? The amount of money and demand for multifamily has increased substantially over the last 5 years, and that's driving the prices up, cap rates down. So, man, we talked about a lot on cap rates. But let's talk about some open Q&A, right? Anybody got any questions?
If people have comments, questions, please go ahead and add it into the chat. Right, we're here to answer them. And, we can talk about cap rates, we can talk about anything else people want to talk about.
Yeah.
Right? And so, let's see. So Trevor says, good afternoon. Hello, Trevor.
Hey, Trevor.
Great seeing you a few weeks ago.
Yeah.
And we'll see him here next week. What's going on next week, Ben?
Oh, we're excited. MFIN, Miami, coming up.
Miami. So if you are located in the,
we only got a few seats left.
That's actually very true. We've gotten a lot of interest, and so it should be fun. And a lot of new people. So if you have been to our conference previously, the one nice thing about this one is it's different faces, right? And we all know multifamily is about people, about relationships and growing together and partners and deals and all that. So
half the business is numbers, half the business is relationships, folks, right? It's a one-day event. We're not selling you anything. There's a ton of networking opportunities. In fact, we're integrating even a bigger part to make sure that people network, because we know that there are some shy people out there. It's July 24th in Miami. We have a lot of people that are coming in early, staying late, making a vacation out of it. Why not? It's Miami. It's July, folks. Have a good time. So check it out, mfinvestornetwork.com. Coupon code disrupt, get your $100 off. This is not a sales pitch. There's really only a few seats left. They're really capping us out.
So we're looking forward to that.
Check that out. We look forward to hopefully meeting some of our viewers in person for the first time. You know, we haven't had a whole lot of in-person events, you know, for about 18 months, so we're really excited about this one.
All right, let's keep going.
All right, we're going,
So
we're going,
chat
we're going.
says, hello, Ben and Ferris. We're all watching here in Mexico. Thanks, chat. Hopefully you guys are having fun out there
checking us out
surfing.
on the vacay.
Let's see. So Amanda Larson.
Hey, Amanda, how you doing?
We missed last week, came out and said, what do you generally use to calculate your going in cap rate? T12, T3, or T1? Honestly, so I'll answer that question. I care more about my year one cap rate than my going in a lot of ways. Now, going in, it really depends on the property. Some properties, if there's not much I can do, I'm probably looking at a T12, right? If there's a value upside, they're actually pushing rents, they're doing upgrades, maybe a T3.
Yeah.
Brokers right now are really just needing T1s and T3s. Brokers don't care about the T12. Like, it's irrelevant to them on the, you know, they're just pushing everything based on T3s and T1s, right?
Yeah.
So that's kind of the market that we're in right now.
Yeah, and you gotta. That's true. I'll say that as well, right? You know, in a lot of the deals, right, you're gonna take a T3. The lender's probably gonna take a T3 on income, probably a T12 on expenses. So just realize that that's kind of how the lenders are looking at it, even the bridge lenders. So, you know, but they're not gonna get too caught up on cap rates. You know, people can say, oh, you bought a 2 cap, you're overpaying. Not necessarily, right? You know, I think it all depends on the story and what is the business plan after you buy it, right? If you're going to put $5 million into it, right? You know, after that year one or year two, after you've done the work, what is your cap rate right then and there? That is really what I would say is the most important metric, right? Versus the going in. But still a great question. You know, I think that people tend to get so fixated on it, you know, in the value add game versus, say, a yield play. It's not as important of a metric.
Absolutely. So let's see. So Trevor says, looking forward to seeing you in Miami. Looking forward to seeing you there as well. All right, so let's see. So Ali on YouTube says, are you guys a private equity firm? Kind of.
Yeah, I mean, I guess what is
a private equity firm?
What is a
really
private
mean,
equity
right?
company, right?
We raise equity with private investors to go buy and acquire multifamily.
We are a private equity company. So. No, we are. We're not trying to be condescending. I think it's a term that's thrown around by a lot of institutional guys.
A lot of people think it's
we are ultimately, yes, we are a private equity
company. We're not institutional.
Company. Yeah, but we are a private
equity firm. That's how I would answer that question.
Absolutely.
So let's see. So any more comments, questions, please go ahead and ask them and we'll answer them live. Otherwise, we can wrap it up a little bit early. Cap rates is an important thing.
What are we talking about next week,
I was going to give people another minute or two.
Oop.
Ben's always talking. It doesn't have to be next week. He's talking next week, today, tomorrow, 2 minutes from now.
I'm just so excited about talking cap rates, you know.
Yeah. All right, let's keep going then.
Okay, so what's coming up next week, folks? The top 3 questions to ask before buying multifamily real estate. Oh.
What are they, Ben?
What's the going in cap rate?
People got to find out next week. Yeah, that's one.
No, I mean, you'll probably want to ask that.
It's a close one. To me, one of the questions is probably, what is the value add story?
Don't give away all the secrets.
I'll give them a sneak peek, all right?
But
Shanna's looking at me condescendingly.
Shut up. No, we'll get into some of those, plus more, right? You know, there's a ton of questions. Ultimately, you need to really get familiar with the market. That's probably the most important thing, and understanding what are the economic drivers there. But we will get into the secrets of those 3 next week.
Absolutely.
What time are we doing it?
Same time as always, 3:30 Central on
Monday. See you then.
So going once, twice. All right, let's call it a wrap then.
We're calling it a wrap now.